And that's very knowledgeable between generations. Now, to invest well, experience, success there, people to be generation business leaders, their life concept, and really, we do that in two ways. We do that through investment in private equity currently, which is our original raison d'etre, Teaminvest Private Limited, and that's sort of 95% of our revenue. We're talking about that at the moment. And then through our growing wealth division, which includes all our fund management practices, corporate advice, reality advisory, of course. And so it's that division, which we call education, which includes us financial education. Certainly. That's up to 8% to 164.5 million, which means that it's grown on average by 6% per annum since 2017. And that's average growth rate. Our look-through EBITDA is up 29% to 13 million, which again is a CAGR now of 59% per annum since FY17, which we're very happy with. Our operating profits are up 61% to 6.7 million, with a completely meaningless CAGR. I would expect us to repeat 1,200% year. Mathematical anomaly, but shows that the growth has been strong. Our statutory revenue up 20%, our statutory profit up to $4 million. Wealth division was established. We acquired half of Conscious Capital, which is the manager and trustee of the Conscious Investor Fund, which has been one of our flagship listed equities products for over 10 years now, founded by John Price, Mark Moore, and Regan and Howard, and Stephen Harrison and Anson Fleming. Fully franked dividends were half or 0.575 cents a share, 5% higher than last year. But the bit that I really wanted to draw out on that slide, which is why it's up here, is despite all of that continuous growth since 2017, and we're very happy with that on an operating basis, our share price, as many of us have experienced, has not followed along that journey. We listed at $1, we're now sitting sub 40 cents. And I just wanted to point out that means we're trading at a P now of only about 6.5 times, which everyone can do their own analysis whether they think that's a buy or not. That's not for me to say. What I will point out, though, is that's currently a 41% discount to our net assets and a 68% discount to our peer median of 20.5 times. This slide in the back of this presentation, you can go to shows you our PSR. You look at our PSR. We're guided by the philosophies of Warren Buffett and Benjamin Graham. If we were acquiring our own shares right now, or looking to do that, I think you would be saying that we'd be looking to add to our holdings rather than decline it. And that's part of the reason why you would have seen recently, I think, two things in the market. First has been that we have been acquiring on-market shares to pay our executives and our board members rather than issuing new shares. So that's been part of the activity that you would be seeing. And I think a number of board members as well have recently increased their holdings. But again, please check the ASX to find that out. But I can say from my perspective as the CEO and a major shareholder, really happy with the year that's been on an operating basis. It's been a great result from our divisional leaders and their teams. Dean and Michael done an incredible job. Stephen's here in the room, as Mark, who runs some of our portfolio companies. They've done an incredible job. What we don't yet have is the market recognising that. And whether that's a case of really greater exposure in order to bring in new shareholders, or whether we're not selling a story well enough, or whether it's just general economic conditions, I don't know. I'm not really worried about trying to fix that in the short run because we haven't raised capital since we listed, so it doesn't really matter from an operating basis. But I think as shareholders, we'd all like that P to be closer to the median, which would obviously result in a significantly different capital gain or loss position, I think, for all of us who've got shares in the company today. That's what I really wanted to cover on that slide. You go to the next slide, Siobhan. The rest of this presentation is going to be much more forward-looking than that. I think sort of talking about the year that's been, I'm happy to answer questions on it, but I don't think I add much in this meeting that you wouldn't have read in the handbook. This slide just talks about who we are. It's in the annual report as well. I encourage you to read it. I'm not going to read through it because I think reading through a lot of text is, you've got much better things to do with your right morning. But really what I want to point out there is that our DNA has changed since we were founded in 2012. Since Teaminvest was founded, 10 years before that, in 2007. Our whole philosophy has always been to assist people to manage their own money well, whether that money was their personal wealth that they are investing in the stock market or in bonds or in any other asset class, property, etc., or whether that was in the purchase of companies where the asset is the people, the equipment, and the operations. So we do that in private equity by assisting the business to run better, and we do that in funds management by assisting people to invest better. And those two pieces are very complementary. They provide each other with a significant benefit. As Warren Buffett famously said, being a better investor has made him a better business person, and being a better business person has made him a better investor. And we see that virtuous cycle, and I'll talk more to it in another slide, but that really is our unique competitive advantage. And so when, as a shareholder in TEP, you're really benefiting from the mistakes we learn along the way, both in funds management and in private equity, feeding back to better returns the year after as we learn, and as our team of portfolio members learn. Our moats, we talk a lot about our competitive advantages and moats. This year, the education section, commerce education, in the annual report was on competitive advantages and moats. Warren Buffett probably says it better than I can. But I thought it was really to just draw out for everyone in the room the 4 moats that we see TEP has, the 4 things that I, as CEO, and our team of divisional leaders focus on a day-to-day basis. And that's our philosophy, which enables us to make better and faster decisions. I think, and Bruce and I were talking about this earlier about our fund manager. I think one of the classic problems in investing is that if you don't have a very core, strong philosophy, every decision becomes hard and time-consuming and risky and emotionally draining. Whereas if you have a very core philosophy that enables you to guide yourself through any market or news that comes out that may dissuade you from decisions become quick and easy. Does it meet your philosophy? Does it meet the rules that you set for yourself? And if it doesn't matter what other people say, double down. And if it doesn't matter what other people say, avoid it. And that's a really unique piece of us. That guides us in all our funds management, it guides us in our team investment education, and it guides us in our private equity. It's really simple. If it meets our philosophy, we're interested and you can act relatively quickly. And if it doesn't meet our philosophy, it doesn't matter how attractive it looks. There's a really simple answer, which is there's a better use of our time and effort. The insights that we generate, especially partners, sorry. The second mode is our insights. This is really that idea that the education we provide and the networks that we access, both inside our business networks and our funds management networks and our education networks, generate through things. They attract a better caliber of contributor. Many of you are contributors. It encourages people to give back to the company with their thoughts and knowledge. And that generates better insights that we can monetize, whether that's monetizing it in a manufacturing operation or monetizing it in a company environment where we're engaging with other public company boards. Those insights that we generate enable us to achieve, we think, over the long run, a substantially better return than we didn't have. It's that classic idea of education and knowledge is power. And we generate those insights through our network and capturing that through a 2-way feedback. That brings me to the third mode, which is our network. Each time we add a new company to the group or a new investor or a new client of education, it increases the power of the insights that we can generate. When we run a breakfast series session for NFPs, for example, which we've been doing recently, and we get 10 NFP CEOs or directors, that generates insight in and of itself. It's not just that we're doing that for charity, that's a good thing, or we're doing it because we want to, provide some advice back to them. We are generating insights back out of the room, which may or may not have value today, but certainly over the long run have value in the ability for us to make decisions that result in better returns for shareholders. And then the last is our full service mode. We've spent a lot of time over the last year building out the missing pieces of the landscape, and I'll talk to that a little bit. And to the point where we now feel that we can start to really wrap around our customers, our clients, on the basis that if they trust us and they like us, we can assist them with other parts of their financial journey. We talk about our noble purpose is transferring knowledge and wealth between generations. That's very hard to do when all you have is one product. That's generating a bit of knowledge or a little bit of wealth. But it's hard to do that multiple times across generations. So as we build out the other planks, and we'll talk about that in a second, of where we've been going over the last year, the whole call behind that has been not only to deliver profit that's is for the company and charity, but more importantly, to be able to provide a full life service offering to the people we care about, which are the investors in the funds, the SME owners who partner with us by selling us a piece of all of their business over time. And that's the bit that we talk about here, is that each of our companies will have their own group of customers and clients. So at Tip Group, we really have three buckets. The first is founders of businesses who want to sell their business to us or have sold their business to us. They're client group number one. Client group number two is the investors in our funds, people who trust us with managing their money, their generations wealth. And then the third is self-directed analysts, mentors and advisors, what we often call our members, Teaminvest, who've trusted us with learning from us to generate the ability to manage their own wealth better than they could without us. And they're the three clients we really focus on. If they're not through our portfolio companies to focus on their clients, so very much trailers will focus on how to make better trailers for their end users and logistics. But at Tip, what we focus on is those group clients, the founders and management of our businesses, because they're the people who've trusted us to buy part of their baby and help them grow. The people who've given us their money to manage, because obviously that's a very, not only legal responsibility, but very ethical, moral responsibility. If someone gives you their retirement savings, a portion of that, you've got a duty to act, I think, beyond what just the law requires to do what's best for them. And then people who want to be educated for the same reason. You can go to the next slide. This slide is a picture in the annual report. I'm not going to talk to it in a huge amount of detail. I just really encourage you to read it, because it talks about how those three sets of clients, we service them and how they interact to build what we consider as our unfair advantage. Michael Barragán, our head of wealth, coined the term an unfair advantage. We consider it an unfair advantage really simply because each piece grows compoundingly with the others. So the unique peer-led network that we've talked about through our education and our advice provides us insights we can use in our fund management, which provides us capital we can invest in businesses, which provides more capital and access to more insights for both the education and funds management. So it's this sort of virtuous cycle. And I've got another slide to show how that works in a concrete example. But really, those pieces around the wheels of that spoke, all of them exist not only in their own right and should be profitable in their own right, and that's the job of management, to make sure they're profitable in their own right. But as an ecosystem, it gives us a unique unfair advantage over pretty much anyone else in the market, because almost everyone else in the market plays in only one or two or three of those folks, which means that the insights they generate, they cannot monetize in the same way we can. They can't do it for as long we think as we can, and they can't add back that value through operating businesses to then generate new insights about other operating businesses, which become potential investments in the way that Tip's been able to do for the last 10 years and going forward to be able to do. Our near-term strategy, again, I won't read through this all in complete detail because I think you can all do that online, but really we've got 4 goals this year that we talk about internally. The first is to continue to grow our look-through revenue and look-through earnings. That's pretty self-explanatory. We want to grow our revenue and profit. We are a company and a business that has to derive a good return for our shareholders. So good. The second is to enhance our portfolio of equity businesses. So that's our original private equity, our operating businesses, through driving efficiency and developing management to sustainably grow their profits from generation to generation. The third is to build a path to sustainable recurring profits in wealth through increasing our funds under management and funds under advice. That's relatively self-explanatory. Lots of new division did very well in its first year, but 1 year or once summer doth not make, 1 year a business doth not make. We need to keep doing that and build that to be recurring year after year. And then we want to continue to make acquisitions at attractive prices of either bolt-on operations for our existing portfolio companies or new businesses where we think their management and operating philosophy aligns with ours. We don't want to invest in things where it's not in alignment with philosophy. So that's one of our core moats and one of our easiest decision-making tools. And so that's really core to us. In terms of what we're looking to acquire in the medium term, that obviously I put medium term because there needs to be the opportunity to buy it, and that may not arise in the next 12 months. There's a couple of areas we're sort of focused on. The first is engineering and manufacturing businesses that service the logistics or infrastructure space, and we think can work well and in a collaborative way with our existing portfolio. So we've got our existing equity portfolio to the size now where we're not necessarily looking to enter completely new industries. What we'd like to do is own our space. So the businesses out there that's in the manufacturing and engineering space and could work with Icon Metal, for example, or in the education space and work with the Teaminvest. They're the kind of businesses we're looking to acquire more. Financial services businesses in particular that can benefit from our unfair advantage. So, financial services, funds management businesses that can benefit from that virtuous cycle and add to it, not just extract value, but add new value back in. The third one is fund managers who we can immediately add their capital to our float. So what we're talking about there is bolts onto the managers who we can roll into our existing funds or run next to our funds with very limited cost. And then businesses that assist in delivering our long-term goal of having 4 pillars, which is the slide I'll talk about next, particularly where we can make those acquisitions on a minority or JV basis. So in other words, we can sort of date before we have to marry. So if we're going to add a new area, we'd really like to do that where we have limited capital risk if we can, but more importantly, we have limited emotional capital risk. So we can actually see if we're all getting on the board table, we're all getting on as founder and as CEO, and then we can double down for acquisition. We've just learned over the years that the people are more important than the assets in every business in the companies. This is how we see the future. I've talked about it a little bit over the years, but I don't think I've really put it in stark detail for everyone, which is really how we see the future of SIP, because we see that as the future if you want to run transferring knowledge and wealth between generations across the scale that we do it. And that's really that we need to have 4 pillars. And those 4 pillars are education, financial services, corporate advisory, or otherwise sometimes known as investment banking or management consulting, and funds management. And really this slide sets out what we talk about when we mean each of those verticals. That's the what, why we want them, and where the revenue is going to be generated. And you'll see that the major revenue drivers there to us long term are going to be the corporate advisory, funds management, education. Financial services we don't expect to be a major revenue generator, but we think it's an absolutely critical piece in managing that flow from division to division of knowledge and insight. So without it, you just get this sort of missing piece and that classic question, how do you got the 10-foot chasm? Well, you can't do it in 2 5-feet leaps. So we need to have that piece in between that enables us to make that journey for our clients and for our businesses. And really the arrows around the top, which we'll see, talk about how we see the flow. So from education, we see education longer term providing referrals into our funds services, into our funds management, and into our corporate advisory as people choose to put portions of their portfolio that they don't want to manage it themselves, or they're not capable, or they want advice. We see financial services referring clients to education, clients who actually should be able to do it themselves, but for whatever reason have historically done so due to working full time and now they're not. We see them referring transactions to corporate advisory because people who are getting financial advice often own a business or own an asset that they want some finance on, and obviously funds under management where they don't want to manage that money themselves. Corporate advisory enables us to structure opportunities for fund management and see them before others. I mean, it's that classic problem of if you're buying an auction, you're probably paying too much. So being able to have our own corporate advisory and consulting team gives us the opportunity in the funds management space of getting outside returns for our fund management investors by being able to see deals and take the best deals, or pieces of the best deals, before they go to open auction. And then in the funds management in the funds management space, really that float, we really something refer to as float in some ways after it refers to this insurance capital float. Funds under management provides you the float that you can then invest back into transactions you can use for develop education products, to develop financial services, and utilise the insights to deliver client outcomes. So that's really important here. The funds management is about delivering client outcomes for the clients of those funds, which means usually a better return in the area that it wants to. So in order to do that, you need to capture insights from education, you need to capture transactions before others can see them if you do that on a sustainable long-run basis, and you need to have the flow to be able to move quickly when a good opportunity arises. So that's really what that's like for us to do. I think understanding that is actually incredibly powerful because I think not a lot of our peers in the space who perhaps play in one vertical truly understand from the client perspective, from a customer financial service perspective, how this all fits together. You go and see a financial advisor and the classic question is, okay, what's your risk profile? And based on the risk profile, you should invest in bonds and property and equity. But which property and which equity and which bond can make a massive difference to the return? And we know that only a couple of % difference compounded for 10 or 20 years makes meaningfully life-changing decisions on retirement or for the next generation. So getting that little bit extra out of each piece by understanding deeper and having insights to share just creates client outcomes that shoot the lights out compared to the traditional, very siloed approach. FY24 update, I'll talk to this briefly and then I'll hand over to Dean and Michael. Dean first and Michael just joined us later on things. Really good start to the year, that's really all I'll say, but it's only 1 quarter, so be careful about trying to extrapolate that out. I would certainly not multiply it by 4 if you're trying to work out where the year's going to be. I don't think with the kind of business you can easily do that, but certainly the year started very well for us. In the first quarter, on a non-audited basis, look through revenue, is at 39.4 million and 358 at 3.9 million, which is obviously a very good result. We're happy with that. Equity remains the biggest contributor to that, effectively providing more than 100 or just slightly more than 100% of that on a profit basis and about 90% of that on a revenue basis at this stage. And that's expected. I mean, really, we've been doing equity for 12 years. We've been doing well for a year, right? So I'd like Michael, and I'm sure he'll talk to that, to catch up to the team very quickly in his division. I'm sure he would like that too, but you can't sprint before you walk and lift the job. Equity as well from that space has delivered 5.8 million of look-through revenue, which is actually really good when you think that the whole of that's well over a quarter of last year's result. Profits a bit down below zero at this point. But again, with wealth, and I've talked about this in my annual report, wealth is lumpy. We get our performance fees every 6 months. We get fees on transactions only when they complete. So it's quite normal with wealth to see that quarters 1 and 3 will be not so great in terms of profit basis. And then quarters 2 and 4 looks much better. I would not extrapolate one of those quarters and multiply it by 4, either quarter 1 or quarter 2, because when we get those performance fees, we get effectively the profit of the last 6 months of work in one hit. So if you multiply that, you got a problem, you're going to overcook it, and if you multiply the first quarter, you undercook it. So just bear that in mind as you see our half-year results and then our annual results as years to come. That will stabilise over time as wealth gets bigger, of course. That's the size of the funds under management, the size of the corporate advisory team grows. Revenue, whilst lumpy, will occur more frequently because there'll be more things we're working on, funds we have. So that should start to stabilise, but it will always be a more lumpy business than private equity. It doesn't have ongoing operating day-to-day, which gets sold, margin gets made, and it's booked. Education continues to deliver, most importantly for us, valuable insights, and secondly, some small profit, which is nice, we like the profit, but really the key for us is the insights that it generates. And it did about $1 million through revenue and through 5.3 million in look-through, which is very good. We consider that great for education. It was a really interesting analogy, and Malcolm brought this up at the board meeting the other day, and I think it's really stuck with me. It's the way of understanding what we think of the numbers that come from education as opposed to the insights, which is the idea that the road service, the NRMA example of the road service division was how you build. So the NRMA was our road service and insurance, right? And the goal of the road service division was to service customers at not a loss, not necessarily a huge profit, in order to build and continue to provide a good service that enabled people to trust you to manage their insurance. And the education for us is the same thing. We don't have any intention of price gouging out of education. That's not the goal. The goal of the education division is to assess the people in it, what gets faced and make a profit so it can be reinvested and get better, because otherwise eventually you can't offer that education product anymore. But the real goal is to help the people expecting in that virtuous cycle, as we talked about with the unfair advantage, that will help us. It will help us through the insights they share that. And it will help us because every now and then they'll want assistance with a corporate transaction or their financial services or their funds management or their kids or their grandkids. And that's when we will make our revenue on appropriate market rates as opposed to the education. So the education is a service that builds trust, that builds knowledge, that gives back in the long term through the relationships it builds. At that point, I'll hand over to Dean for an equity updating. I'll ask you if you can just take the microphone, Dean, so otherwise it's struggle with the recording. Thank you.
That's working now. I'll just adjust the camera just for those on recording also. So. What? So I'm going to sit if you want me to. Have it, take it relaxed. From an equity side, people have often asked, what does equity actually do? What are the companies? How do we actually describe it? And if we truly look at equity, equity is an infrastructure and industrial engineering set of companies. That is the sector we play in. That is where we provide our competitive advantage. It's where we are better than our competitors. And often we talk about companies and say, how do we do it? Are we better or are we faster or are we cheaper now? We don't want to be faster or cheaper because you race it to the bottom. Okay, someone can always beat you in speed. We want to be better, we want to be value adding, we want to add value to our customers and our suppliers, our staff. Because when we can add value to everyone and create a strong culture, we'll grow the business. And that's what we focus on when we're looking at equity. So Our mission is to build a great people-focused, high-performing organisation delivering exceptional results. So I think Andrew's spoken about some of the results. You've seen some of the growth over the last year. I'll get to this year's first quarter, but I'll reiterate, don't expect to multiply this by 4. So our values are including customer centricity, honesty and integrity, unequivocal drive for excellence, action oriented with enthusiasm, energy, tenacity and diligence. We've got to be flexible. We've got to be the ability to adapt, adjust. We can't be rigid in today's environment. We've got to understand what's happening at us. But the last one, understand the why. Everyone says, oh, you've got to ask the why. Yeah, you can ask it, but if you don't understand why, then we really don't know our levers. We don't know why we do what we do. We don't know how to move or when to move. So that's one of our key values, understanding why we do things, really driving that to the core of all of our businesses. And that provides competitive advantage. In our first quarter, we've already achieved 53% of the full year and for FY23. That's taking tax of 30%, which is quite a good result given the growth that you saw in FY23 from previous years. So we're actually doing really well. Our businesses where they're sitting, if you look to the right hand side, you'll see the order of which they deliver those profits. So that is a ranking order. Okay? Deliberately done where they sit. So those companies should be very proud of what they've done. And isn't an overnight thing. GLT have driven it, and a large amount of GLT's drive has been a price change. And we've really upped the prices. We're starting to charge the value. The rest have got the thumbs up on that.
Two thumbs up. What do you think years for that?
So that's the driver of GLT. East Coast, they outperformed last year and they're continuing to do it under Greg's leadership. Icon under Stephen's leadership's gone through some pretty tough times over the last few years, COVID, the industrial building sector, but he's really turned the corner and doing a great job. Multimedia, Colour Capital, Automation Group, Teaminvest, Teaminvest, and Decade, all progressing along really well. So we're really comfortable where we're heading. The GLT expansion, we've agreed, we haven't signed, so I say there's still opportunity that doesn't go through, but I'll say we've agreed. To lease a state-of-the-art 14,000 square metre facility from ATSG, which was the group that acquired the Maxi Trans manufacturing section out of Maxi Trans, that was the listed company, which is now Maxi Parts. So they're moving out of Brisbane due to an acquisition for them. We've agreed to take this as of 1 April. It expands our capacity by over 100%. We're expecting efficiency gains from there because of the way they've set it up. But the facility is only really 3 years old. It was set up to what we would probably call German engineering standards. And 3.5 years ago, and they've decided to exit for strategic reasons and relocate back to Ballarat in Victoria, where their main site is. So they've left Queensland with the whole workforce, which is one of our biggest challenges today, is labour. We've got the opportunity there to really grow GLT and take on exponential growth. It has to be done wisely, but the opportunities there that we've set up and looking to do. Part of that, Graham's still working. Graham's still turned 81 in August. So he's still keen, still motivated to go with that. And he's going to start focusing more on the R&D side. So within the leadership in there. We've had our first equity strategy days. It's had outstanding feedback and enthusiasm from the team, where we're starting to work. We'll call Teaminvest, but the equity companies need to be undertaking on work together collaboratively and actually start sharing ideas, sharing knowledge between them. And for those that were there, they'll say that is now starting to go. We're now starting to work collectively. CEOs are talking finance, they're talking sales and marketing, they're talking HR, are talking between the companies on a monthly basis. They actually engage and grow each other. And that's using the collective wisdom and model that we've got here at Teaminvest to grow the companies. So we're really working strongly on them. I think we're going to have a great year. Over the city, I think the times are tough. I think we're going to see interest rates change and the rest of it. I'm not going to predict any of that, but I think that will put some pressure on some of the margins. But we're positioned in a really strong position for growth of the equity division going forward. So thank you.
Thanks, Nick. Michael, is Michael online?
Yes, I'm here.
Yeah, it's on.
Yes, I might just hand over to Michael and Michael, mute you or.
Yep, I'm here.
Michael wasn't able to join us today. He's had a major changes, a very close family member fell over last week, and so couldn't be with us as well.
You've got to stop sharing.
There we go. There's Michael.
And then
Brilliant. Yes, thank you. Not many things would stop me from being able to fly over there this morning, other than something like this. So we'll
Hang on, your sound not coming through, Steve. It's just hang on a second.
Yep.
Like that, we have to turn up the volume.
Okay.
I don't have anything.
Right.
Just hold that near there and play it. If you're trying to work that truck.
Bye now, Michael.
Right, is that better? Do you have audio now, or is that still a bit too quiet?
Keep going.
That's a bit better.
That's a bit better?
Yep.
Brilliant.
Yeah.
Happy for me to kick off?
Yeah.
Brilliant. So yes, thanks, Andrew. There's not many things that would stop me from being able to fly over for this other than this particular thing with families. So thank you for your understanding there. The wealth division is obviously still in building phase, and that does result in lumpy revenue. So the reality of corporate advisory is that some of the transactions we have at play exceed the total revenue for the first quarter. So we're looking at ways to smooth that out. We enjoy our monthly conversation with the accounting team on how best to record work in train and work being completed. But obviously the intention is to build our funds management and advisory teams as our corporate advisory continues to drop in large lumpy contributions to the business. So overall going quite well, really proud of the team that we've put together and the culture that's been formed. And now it's about basically taking advantage of those early investments into our legal precedents, into our documentation and technology and things like that. So from a mission and focus perspective, our team is really focused around our corporate advisory team and the delivery of bespoke products. What we're looking to do in wealth is address the key challenges that most of our competitors have and put us in a position that allows us to scale and take advantage of potential acquisitions that might come up in the future. And what I mean by that is that the biggest single challenge most wealth businesses have is the very high cost of wealth wages, I should say. So key people, the dependence on key people, and the inability to obtain the right staff when you need them. So what we've been doing is making investments in technology to augment the intelligence we have and not replace it. Our view is that the ability to acquire high quality staff will not go away as a problem, and we need to look at every element we have to create a resource light and a highly scalable business that can continue to spin off dividends for our investors. So to that end, we've made a series of partnerships and entered into arrangements to launch new offers. So you'll see in that quarter update, we've launched an SMSF service offer. And the reason for that is it is very much what we already do in funds management, just on a one-to-one scale. And that suits quite a lot of existing Enva clients and through our network. Just something we were able to, frankly, spin up really, really quickly and provide that so that we continue this objective of wrapping around our clients and making sure that everything they need is within the TIP ecosystem. We've entered into a joint venture with Climb, which is another listed funds management group. They have a long history of client education, a very great cultural fit between the executive teams, and an intention to want to provide something to retail consumers that would help them address their own affairs. We know that there are largely two groups of people with respect to financial services: those that want someone to do it for them and those that want to research everything and do it themselves. My Financial Fitness is a program designed for those that want to do it themselves. It's designed to give them all the tools they need to make their own decisions, and then to be there to capture the opportunity if they decide that they would like to engage further. So it's the type of project that if either business had done by themselves would be a thing that would sit in the corner and not get attention. When you have two companies working together on it, you get a high level of accountability, desire for success, and key milestones being met quickly. So the intention with that is to have a broader presence in the retail space and feed into that education part that's really important to the way Tip Group operates. BizGPT is a AI platform that we've tilted up in partnership with a group we have already worked with before. They've been, frankly, just very impressive in their ability to tilt up a tool that is secure and reliable and leverages some of the language models that have been coming out into market. It's something we're implementing in our business, and the reason for that is that it allows us to augment the knowledge centres we've got within our business. So it's what we've seen already, and I personally am using it now, is the ability to create content, refine content, and scale the resources we have in our team really, really quickly. Quite exciting. Without talking about it too much, the key benefit for us is the ability to curate the content and know that it is secure and it's our data that's being referenced for the creation of new content. It's very, very powerful once you understand how to train these models and how to leverage them. And we're really quite thrilled to be able to take advantage of that. It goes back to my first point, which is people, wages, the single biggest expense and risk to wealth. These sorts of investments provide us this great platform so that when it comes to acquisitions, we can reliably look at significant upside when we take over other businesses or just win new clients. That it's really about providing us with a cost advantage. That's not to say people aren't important. These systems only work, in my view, when you have an intelligent person looking over them and looking at the results that come out. So we very much see this as an augmentation strategy, not a replacement strategy. We have a raft of live services that are running now. So retail and wholesale funds are running and receiving new inflows, which is great. We're looking at this quarter at really dramatically improving our group reporting. So we're just investing in other systems there to make that a little bit more streamlined. What we focused on initially was just making sure the customer experience was great, and now we're taking care of ourselves. So that's been our strategy with our funds management. Corporate services, and I believe Andrew spoke to this before, is really about creating a moat and then being able to leverage that. There's huge opportunities in the Australian market. There's large areas that remain underserved with respect to debt and private equity, and that's why we focused our wholesale funds around the ability to lend out to certain business opportunities as we see them, or to enable landowners to take advantage of the potential development within their site. So the way we approach that sort of corporate advisory around debt is very much to support the landowner in maximising their value. So as an advisory service, we're not developers. It's a fantastic opportunity that we'll continue to talk through more over time, but it's really about taking our advisory intelligence, leveraging our funds capability, and delivering significant upside for the stakeholders that are involved. So that's probably enough from me on our group, but overall, great team. A lot of integration work happening across private equity. Myself and Dean talk really regularly. We've got a body of work underway with Kitome and continue to just sort of build and improve and just make sure we've got a really great platform for a long-term and sustainable operation.
Thanks, Martin. Thank you. I think that ends our official presentation. Do you want to do questions now, Malcolm, or?
In respect of the presentations, if people have any questions, now will be the best time to ask them. And then we'll go on to the formal matters of business, which will also provide opportunities for questions in respect of each item of business.
Any questions? I suppose we've got a couple of questions. Sure, I might just give you the mic. Sorry, Joyce. Thanks.
Well, I think the first one is, we understand the sort of, well, I wish I could say I fully understand the philosophy of the company, but a lot of that's to do with you guys being there and being kind of the holders of the torch, you know what I mean? So how can we ensure that, you know, that philosophy goes ahead, because it seems to be, you know, really good, sensible,
Yeah, well, because it's more good to say we're here to transfer of knowledge of between generations. If we don't look
yeah.
in the generations ourselves, right, internally. So it's a very important question that's something we look at a lot. I'll take these sort of a couple of sections. So on the Teaminvest side, which is the development of the business investing philosophy, the Teaminvest membership of facilitators has been undergoing a, geez, careful how I phrase this, Mark, averaging down in age, but not loss of wisdom. Is that maybe a way of putting it? We're trying to find younger facilitators than we have been from within the membership. The advantage we've really got in Teaminvest in that sense is that once you've been a member for a number of years, we hope that our philosophy is ingrained enough within you that you can lead your local group if required. And we've added a number of facilitators over the last couple of years, Mark, who are on average younger, slightly less grey hairs, maybe than the group. So that in protection of that philosophy, which is probably more of everything we do, I think that's been sort of happening on a regular basis, just through the systems that the teams built. On the tech side, on the private equity side, there are two things about that. There's within the companies, which is obviously a challenge to the team in this team, look at with the management of each of those portfolio companies, diminution, GLC hiring, a new CEO earlier this year, stretch funds to the an absolute suits, and inculcating that philosophy. But there's also my job around making sure that the divisional leadership, so Dean, Michael, anyone else who joins that, are absolutely brought up to speed with our philosophy quickly, because I'm very cognizant of the fact that what we've built over the last 12 years could suffer significantly if we make the mistake of so many fund and private equity managers of relying on one or two people to drive the why. So we do require, as part of the contracts that, or not contracts, but part of the KPIs that all of our senior leadership attend Teaminvest meetings around the country to build them within that philosophy. We expect our board to do that as well. And I think over time, we'd like to expand the attendees of those meetings beyond just senior leadership to 1 or 2 levels below that as well. But I'm also cognizant of the fact that getting executives to step out of their day-to-day business, if they're manufacturing or engineering, to look once a month at companies, whilst they're very valuable exercise, sometimes not easy to show the value immediately. It's so hard to convince them to drop tools, literally drop tools, and come in and listen. But I'm working on it, and the ones in the room know.
And I think the second question is, I'm making it not too big, is I feel that there's a couple of big tsunamis coming through change. And obviously you talked about AI with at least GPT. I come from an IT background, so it's almost like a hobby for me to look at what's going on. And then there's all this financial change, which is like the cryptocurrency or the distributed ledger technology that's pushing through. That seems to have gone off the charts from those people, but it's going to be a part scenario. So are those kind of things, obviously with this GPT, but that seemed more to do with content. I don't know if I got that right. But to me, it's almost a tsunami. Some of the tsunamis actually just don't have to be bubbles, but I really feel that those two things, finance and artificial intelligence, are going to be good things there. I saw that you said you adapt and change as we go, so I was just wondering a comment on that. And that's a bit of a big thing.
No, it's about, look, I'm going to do it, but I love this stuff. That's I spend far too much time researching these things. I think a bit like you. I think we are at the same point with AI, and less so distributed ledger, but a little bit of it. I think the AI is the more important one, but improved from. In the same way as we were in the early 90s with the internet. People are just starting out of academia into the business world to realise that the opportunity here is not just for the nerds, but people are struggling to work out how to use that to monetize it. And we're really lucky. I mean, we see how it had very face in the early 90s and early 2000s talking about the internet and the department businesses having adopted it. So we're very lucky on the board to have this view, but I think that's how I would put it. The technologies that enable the way we make money out of these things, we're not going to build the tech and sell it on to someone else, right? That's what I see it. But we're going to use them to make money of our business, our whole portfolio, not just funds management. It's using it to either make our businesses more efficient, to increase our margins, or to access more customers. And so, the BizGPT one is a really good example of us trying to use AI inside head office and wealth to begin with, and we are starting to connect our portfolio companies up with it to see are there ways that we can, in effect, speed up the delivery of our insight generation or speed up the delivery of our insight dissemination. So either come with insight we would have otherwise through looking at big data, or more likely the insight that we've had, can we get that out to market to be useful faster? Like, for example, instead of taking, actually, weeks and weeks to write my letter for the annual report, because you pour over it, trying to get it right and agonize about, can you do that in a day with AI? And so you can disseminate that knowledge and that is something to capture it within our operating businesses faster. And that's really where I think, in particular, the first wave will come. The next wave after that is going to be the obvious one, which starts to say, well, if you can do things faster and more efficiently, you need people. Just the next thing with AI and computing, right? And then the original one, I don't think it's going to result in less employment. I think it will be extremely important. I think that a junior law clerk just researching for their boss with something like this GPT, where you really focus, where this GPT focuses on providing a compliant output, and how I define compliance different to accuracy. So accuracy is right or wrong. Compliance is it's right and it stands up to muster on review. It's got the level of depth of reasoning behind it. That starts to change the dynamic of cost base in a lot of industry, but I don't think the tech's quite there yet. We're working with USW on a project about developing a way of measuring compliance. But that's the missing piece. If you can't measure compliance, you can't rely on the output. There'll be others who can't crack it before us. It's just doing that. But that would be the next one. And I think our sector, energy is the group talking about this. It's just another way of technology to improve how we do this. We want to be always on the cusp or the forefront of that. We don't want to be the first provider and expense all the R&D ourselves, but we definitely want to be second before anyone else catches up. And that gives us a leg up in our industry that drives their efficiency and profitability. So I agree with you. I think there's a whole bunch of things. I think the debt hangover the world's got. I think the political hangover the world's got from authoritarian leadership. I think what's going on in this is an interesting time to be in the market as a manager of funds and as an operator of businesses, and that's a huge opportunity. Areas of disruption sort the top performers from the week. As Buffett so basically said, you can only tell this when you're naked when the tide goes out. I think we've seen a period in the last 5 or 6 years, and I've talked about some previous AGMs, where it's been difficult to acquire good businesses at reasonable prices because the debt's been cheap, interest rates have been higher, etc. That's going to change. And sitting on cash like we've had, being clear with our philosophy so we know what we want to target and being able to move quickly. I think this is a really exciting period for us. So I can't predict to you when that's going to turn behind it. The market can remain irrational longer than any individual can remain so.
And just thinking about the sort of distributed ledger technologies that are moving very fast and even can move off blockchain by look at it, that kind of thing. And how does that, because that's a real financial services change.
Yes, we had to talk about it for a lot of the sort of heads blockchain research, you call it, I suppose, at USW. So we've got a research partnership with USW, it's really good. So we access to a lot of good stuff. I think it's at an earlier cusp of AI in terms of its ability for adoption for a business like us. That doesn't mean it's not going to change the world in various ways. It may well, but I don't think it's not yet ready. We haven't yet seen the ability to apply it in the way that we're seeing in AI. So I thought it will come. It's just going down. I think something like the ASIC or the RBA is going to see it first and then that'll pull through. There's a lot of issues so far still with it.
Okay, anyway, thanks.
I've noticed in recent years that the only equity business you've taken out being more in the financial services. Whilst you highlighted that you want to take opportunities to purchase businesses outside the financial services, it doesn't seem to be happening. Or I'm wondering whether this is a conscious decision to move away from the equity side of the business.
No, we have done some bolt-ons that happen to be large enough to be able to disclose to the ASX. There's rules around what we can talk about, but ECT's done some bolt-ons and others as well. We haven't bought any new standalone businesses that are in that space, and that's been a function of a couple of things. One has been price. The price of the business has been one thing that hasn't been our philosophy. And in that period of sort of free money, it wasn't uncommon to see a private business that would have historically transacted at 3, 4, 5 times impact to, seeking 15, 20, 25 times impact, and we just another game, that's kind of prices, there's someone else. And then the second thing has been that to some extent our time has been focused a little bit on driving efficiencies within some of those companies now that we have 100% ownership of them, whereas in the past, we would say 40% owner, we didn't have that same control capacity, control the wrong word, but that same level of ability to influence decisions. And so, you would give advice, but not get your hands dirty. In some ways, what you're doing. Dean spends a lot of his time doing that now, his team. But I think really, the thing what we go with is we keep looking at lots of transactions in equity, we keep looking at them. Our problem has been when people's houses are tripled in value and they think that they can see, that someone sells some new tech that's got revenue and no profit for $100 million, then they want, a price for their profitable business that we just don't think is reasonable in the historic scheme. Did you want to add anything on it?
Yeah, so I spoke about the better, cheaper model. There are a lot of businesses out there that are commodity style businesses. That's not where we play well. And a lot of those cheap money did well. And then you see them come to the market quickly. We've got to pick the eyes out and you've got to see how it's going to transition with our current leadership models, how it's going to integrate, how culturally they're going to fit. There's so many things to why we would buy our business, but also why we wouldn't is probably the big reasons. I would rather not buy than buy something that we're going to end up having to write off. Okay.
That was a few times too.
Yeah. So like you asked, we've learned from the lessons, like there's been a lot of analysis on that. Okay. So we're discussing things at the moment internally, and I would hope that you might see one by the end of this financial year. Okay. But I don't want to jump quickly. I don't want to be rash and just say, let's just go and acquire it.
Yeah, if we talk about, market philosophy, like it's buying a good business at a good price, not a good business at a stupid price or a bad business at a good price. And the last few years in the market, you can see it's at the venture capital data and the private equity data, prices have been well beyond their historical trends. As students of history, to get involved in an auction and pay 3 times what you would pay for a business 18 months before, it just does not get being right or Michael or you pull it out of bed with a smile. We just say, look, you know what, that's you. You do you, we'll keep our cash, we'll reinvest it in our businesses, we can get a better return and build the waters, which is what we can do. And it's a bit different wealth because just on that note, the Royal Commission shifted those multiples a bit. So the wealth multiples that were crazy at the start of that free money period came off the boil faster than we've seen in manufacturing, engineering, and infrastructure, because a lot of them got hit with Royal Commission rules and went from it's just a par now, there's more compliance work and we don't want to do it. And so they've come down to prices that we're more protected.
And one of the things I'll note and say that we've got to be cautious about when we're acquiring at the moment. We've had this instant asset write-off period where a lot of people push and force their capex into a period where they got the write-off quicker. So those numbers are looking elevated at the moment. So trying to pick what it is through the cycle isn't easy at the moment because of that tax incentive that really does impact. So we've got to be mindful and really do a lot more analysis than just take it at face value because of how some of those cheap money options have come through. So I think if you understand why we're being a little bit cautious, that's one of the reasons.
Yeah.
Also need to be more cautious with this decision buying in terms of the culture which should be created in the first place.
Yeah, and one of the things that the board will tell you and the executive will tell you, culture for you is the biggest thing. Culture is what we have to get right, because people are our business. And that is ultimately our best thing. So we've got to buy the right culture, and it's got to fit in with our businesses. If it doesn't, then we could destroy our business. We've got to be mindful of that.
Yeah, and I'll just add to that, I mean, I've talked about this a few annual reports ago, and I'll keep talking about it, because it's an important point I think that should always be stressed. We will never get everything right. We will regularly buy businesses or bolt-ons or stakes in things or make business decisions that are wrong. Our goal as investors has to be, though, if we're doing better than 50%, we set ourselves to target 85%. We've got a lot of research in Teaminvest that allows us to get to replicate that relatively well over the long run. That's what drives compounded value growth. But if we ever want to set ourselves or think we're going to set ourselves a goal of 95 or 100% accuracy, all we're going to do is kill ourselves and actually blow up farm capital. And it is something, because I sort of think a portion and look at the accounting rules lends itself to this conversation regularly. When we buy a business, if we get it all right, we never get to show you any of that other than in the aggregate numbers as well. But anytime we make a slight mistake, we are required to disclose that and to take an impairment against it. Even if it's not stuck after, even if the mistakes that it's now more profitable than it was, we've still taken the impairment, or at least disclosed it at the bottom to the extent of an impairment that we've talked about as a potential. And that's unfortunately, I think, something across corporate Australia that we really need to fix as a country, but it's not to me, it's accounting rules. But it just creates this sort of inertia around, if you're not careful, that's why we talk about we're not going to be 100%. Because if you sit there as an independent director on a large public company and you say, I can only ever make a decision if it's 100% right, how can you ever make a decision? And I think that's just something we should be aware of. We'll get involved, we'll tell you about it when we get involved, we'll get more rights, we hope. We won't necessarily tell you when we get it right, because the ASX doesn't like you talking about that. So if you want to know what our results are in terms of our actual performance of operating business, look at our look-through revenue and look-through EBITDA, and if it's growing at rates it's growing, and it has been growing, I'd argue we're doing it right. But you will still get every year a section on what we've done wrong, because that's required, and there won't be the same section on what we've done.
I think Michael about one of this is something that's going to be.
Oh, yeah, sorry, Michael.
Yes.
Yeah.
Heck, Michael.
That's great. Just very quickly on the acquisition. So I just wanted to quickly say that of the acquisitions we've considered internally, I'd say there'd be 5-to-1 private equity to wealth. So the vast majority of the work we've been doing on potential acquisitions has been in adding to private equity. I think the general view on the wealth business is that we have a fundamental opposition to most of the valuations for wealth businesses as to what they deliver value in, how scalable they are, and other factors that lean us more towards private equity. Wealth transactions to me look more like strategic partnerships or leveraging areas of service that we don't want to get into. So I agree, and I wanted to answer this question as well, just because I know it came up last year as in the previous AGM, that the vast majority of transactions we looked at have been private equity. But it does come down to the points that both Andrew and Dean have talked to, that once you have something, when you look at the resources and the time Dean's been putting into our current companies, it's starting to become clear that you have to be pretty special to fit into the team that Dean is building. And that it gets harder and harder to find great companies. Something we know our Teaminvest members talk to quite often. When you look across the entire ASX, it gets harder and harder to find really good companies that are worthy of investment. So just a quick comment from me, adding to Andrew and Dean's points.
Questions?
We've got I don't think there are any other questions. Just before we conclude this session, I thought it might be worthwhile for people to hear a couple of words from each of our directors, so that they do participate in what we're trying to do as business ideal. So without further ado, I'll just give Howard.
Okay. Thanks. Based on a couple of questions that were asked there, I think we're fortunate in that the board we have is very, very interested in technology, but not technology for the sake of technology, as I've always joked, although I've got a science background.
The actual technology itself and how it works doesn't enthuse me. It's what it can do to do one of the 7 things that make a business more profitable. Things like increase sales, reduce costs, get rid of processes that are slow, make transactions easier, etc. There are only 7 ways that you can, in fact, improve profitability. So when we look at something like ChatGPT or cryptocurrency or distributed ledgers or whatever, the question we always ask is, which of the 7 ways could we use that thing, and hopefully more than one of the 7 ways, but which of the ways could we use that? We don't want to be an originator of the technology. That I don't think enthuses certainly me, and I'm from what I've heard from other board members the other side of that. In terms of finding companies to buy, the world's been going through a period of incredibly low interest rates and booming asset prices. I mean, I'm sure you're in a similar situation, but some of our living houses have tripled in price since before COVID. That's nuts. It's the same house that it was before COVID. You've got companies like WiseTech that gets to a PE ratio of 150, which is crazy. You've got private equity or sort of private companies turning around and saying to us in meetings, oh, well, I saw in media that guy started that company, it's never made a profit, and he's got a valuation of 500 million, and it's going to be a unicorn soon with a valuation of $1 billion. So my company makes $1 million a year in profit, or 2 million a year in profit. So what are you talking about? I've got much more money than that. So there's a lot of laughable things going on, as there always are, at the end of the period of the bubble. And I believe we're at the end of the period of the bubble. Will that bubble deflate slowly or will it burst? I don't know. Usually they deflate slowly and you only realize that it was the bubble 5, 6, 7 years later. Very occasionally they burst and everybody knows about it, like the GFC. So more likely it will deflate slowly, and we're already seeing this. There are a lot of companies on the ASX that the share prices and their PE ratios have come down by a third in the last 6 months. Which ones are they? They're the ones that were on the highest PE ratios of the lot. The ones on lower PEs, that probably hasn't happened. So I'm hopeful that in 6 months or a year, don't tell me it comes at the exact time, but in 6 months to a year, we'll start seeing a lot more interesting private equity deals than we see now. Not because the businesses will be better, and I still have to pass all these cultural hurdles as well as all our financial hurdles, but the expectations of the person watching us to buy an interest in their business will approach closer to reality than the la la land that's been recently. And I think that'll help. And in terms of things like artificial intelligence, I'm pretty sure in the year's time, you'll see many of our companies using aspects of that to run their businesses better, but we won't specifically be an AI company, I don't believe.
Thanks, Howard. Thank
you, Melbourne. Yes, I'd just like to comment on, so I don't know your name, I haven't met you before. Stan. And Stephen obviously brought up a similar theme. And this, and I think it's something that as a board, we've got to recognise that perhaps our communication hasn't been as good as it should have been in terms of philosophy and where the business is going. We understand it and we try to communicate that, but I think there's a learning that we can take from that as board to say, okay, well, perhaps we need to be a little bit clearer, emphasise things a little more. In terms of your other comment on things like ChatGPT, artificial intelligence. Now, I'm currently the chair of the Risk and Compliance Committee, and I know that this is something that is very, very forward in our thinking in assessing those risks. And of course, that is communicated back to the TIP board. We reflect on our investigations. They're the sorts of things that we're looking at all the time. And of course, this changes dynamically. And it's not something that we want to overlook. So we're very cognizant of those sorts of risks. The other point, again, going back a little bit, for many years I was the chair, many of you will know, I was the chair of the investment committee. And in those days, in the early days of Teaminvest Private, the investments were made
on the basis of basically individuals deciding whether they want to go forward with those investments. And a lot of those were very successful, others not so. Currently, where we are deploying and looking after the interests of shareholders, we've got to have a slightly higher hurdle, I guess, in terms of when we will deploy funds. We've got to be certain that those funds will be at least protected as much as possible. And I think if we look at it through that lens, it perhaps gives you a better understanding of why we would perhaps not be making as many acquisitions as we have in the past. I know in my last period in the role of chair of the investment committee, we spent a long time, about 12 months, assessing one particular acquisition, only for it to fall over right at the end when we were sort of getting to the point of making an agreement. So they're the sorts of things that have been going on. So, but thank you for your comments, and hopefully have more.
One of the most exciting things about Teaminvest for me is its ability to harness what I think Stan called the tsunami of changes that are coming through industries right now. And I think that the ability that this company has to put executives out of their day-to-day job on a regular basis and bring them into strategy sessions where we look at exactly those kind of things, AI, ChatGPT, blockchain, and the application of these new innovations to the various businesses, and forcing executives to think out of the box in terms of how these applications, to get back to Howard's point earlier, can make a difference in their own business, and how to monetize the applications in a way that adds value to Teaminvest. I genuinely believe that Teaminvest is, over the next while, whether that's the next half or the next year or two, Teaminvest is reaching the scale where we're going to get to the tipping point, where we're going to see a real difference in how the tsunami of changes coming through is going to impact the businesses in our portfolio. So personally, I think it's an exciting place to be, and we'd like to thank you all for your participation and engagement with the executives and the board here today as well.
Thank you, Ian. So that pretty much concludes the presentation of the company's performance and discussion about where the management was thinking. We now go on to the formal part of the meeting. Essentially, there are 11 items of business. The first item on the financial statements is not a voting item. So there's just items 2 to 11 that will require voting. The number of proxies that we've received. So all shareholders get the opportunity to allocate their proxies in either voting directly or allocate them to a person who's legal proxy and vote them on their behalf. In respect of each resolution, for the proxies appointed in the notice of meeting, we will show on the screen, whilst you've got the first resolution up there now, that's not a resolution item, it's a discussion item. But for each item 2 to 11 that are resolutions that require voting, we will show the resolution and the proxies that have already been received and how they've been allocated. Now, in considering that, any discretionary proxies that I've received as chairman, I will vote in favour of the resolutions for the meeting, just so that people are aware. So if you see open proxies, that those that come to me as chairman, I'll be voting for those resolutions. All right. Moving on to the items of business. People can ask questions at each item, so there's an opportunity there rather than having to remember as we go through it. The first item of business is to consider the annual financial report of the company for the financial year ending 30th of June 2023, and its related reports. I've already mentioned there's no vote on this matter. People are entitled to ask any questions they can have of the management. And in addition to that, we have Brian Pollock, who's the auditor in the back, if people wanted to ask any related question. All right, so without any further ado, Are there any questions concerning item 1? No. I think that it seems that there's good signs. So hopefully it's the presentations that address some of the matters. All right, so we concluded item 1, and we'll now move on to item 2, which is the adoption of the remuneration report. And on the screen behind me, you can see what the resolution is. And everybody read the resolution. That's what so everybody read. That's the resolution, which is essentially the adoption of the remuneration, company's remuneration report for the 3rd of June 2023 be adopted. You can see underneath that it has the various proxies and things. And the open proxies are the ones that I was referring to before, that if they've been allocated to me, I would be voting them for. So people have a card if they didn't want to vote anything here. They can. Are there any questions on the remuneration report? No. Okay, so we move to item 3, which is the re-election of me as yeah.
Thanks, Malcolm. Item number 3 is the re-election of Malcolm Jones as director. To consider and if thought fit to pass the following resolution as an ordinary resolution. That Malcolm Jones, a director, retires by rotation in accordance with Rule 4.7b of the company's constitution and ASX listing Rule 14.4, and being eligible offers himself for re-election, is re-elected as a non-executive director of the company. Valid proxy votes have been received as indicated below, and the total number of proxies received in this resolution 54,681,000. Are there any questions on this resolution? If not, I'll hand back to Malcolm for the next one.
Thank you. Thank you, Randy. Item 4, the appointment of auditor. Item 4 is an ordinary resolution to appoint BDO Audit as the company's auditor. The full wording of the resolution is there on the screen, and the number of proxies also noted. Are there any questions concerning the appointment of BDO Audit as the company's auditors? No, thank you. Okay, next. Oh, sorry. Please. Thank you.
What was the reason for KPMG's resignation?
Yeah, why don't we give you in front of you? No way.
The reason behind KPMG's resignation, not too much of a surprise. Well, it depends how much of the week you want me to get into, but really what it got down to was they didn't have the capacity. Auditors are in short supply in the country, accountants are in short supply. And therefore, when you're in short supply, what do? Put your price up. And how high did it get? Yeah. Quite high. So I won't give you the exact number, but that's really where it came. Thank you.
So having no votes for BDO, isn't that going to encourage them to charge more? Shouldn't we get a see? He just I'll say no.
Well, I think one of the points of it is the timeliness of getting the audit done with the financial information, and full credit to Ryan this year in working with Dean to complete the exercise. The cost is one exercise, but getting it done efficiently is a really important part, because if people have ever worked in business where you've got the auditors coming in and things like this, and whilst people understand it's an important task, it can be quite time consuming and frustrating if people don't work well with you. I think that's also part of the exercise. So when you're short staffed, then it tends to be, you should be thankful that I'm here rather than
working with you.
Yeah, I guess the other side of the short staff, if you guys wanted it to be released in October, maybe we could have agreed to it, but I don't think the ASX allows us to do that or anything. So as Martin said, that short staffing really does impact us in numerous.
This is just very brief. The audit for a second year is far more efficient than the audit for a first year. So presumably the fees won't increase.
Hopefully they'll go down these ways.
I thought you were coming out of retirement, Bruce.
I think it all depends on whether it's the same issues. It's the things that emerge year on year, challenging parts. But I think it's very important, as you say, Bruce, that people understand the business and where you're trying to head. So that when you see some of the issues that arise, you have a bit of background to it as an auditor, which I think makes the decision-making process much more relevant, rather than sort of a bit esoteric. Sometimes you can get caught up in the detail. They used to have a term in auditing, substance over form. Unfortunately, I think you get to the stage these days with financial services as well, where it's all about form and not about substance. And hopefully we can get that balance back, because that's meaningful for all of us. We don't want to be caught up in forms for the sake of forms. We want to be caught up in forms because they're worthwhile in a substantive manner.
And I'll say on Ryan's behalf, or Ryan, that he's more that way than we found back in there.
Thank you.
I'll accept that. That's happy to take the comment.
Yeah, thank you very much. So let's go. Are there any other questions? Liz? Right, thank you. The next item is item 5, the consolidation of shares. And for this item, I just want to ask Howard to just say a couple of words on this topic, because Howard actually raised it as a suggestion initially, which we discussed. But I think it's worthwhile to understand the deliberations we went through in suggesting this course of action.
Yeah, the reason originally that I raised it was, as many of you know, I'm on AusBiz every now and then, Marcus as well, and 8 of the 10 companies on average, sometimes it's all 10, that come up on AusBiz, Mark and I and everybody around here would probably regard as total junk, and most of the junk doesn't make a profit. That's what we mean by junk. It doesn't make a profit, never has made a profit, probably never will make a profit. And many of those have share prices under $1. And the kind of reaction that we've regularly had from people, both on AusBiz and outside of it, is if your share price is less than $1, you're among all that junk. So seeing as, unfortunately, our share price seems to be, in my opinion, ridiculously low, as you can tell by the fact that I've been buying shares whenever I can. Don't take that as advice, and everybody do your own due diligence, but that's my personal opinion. We thought that it would be a good idea to have a consolidation of 5 for 1, meaning that our share price would then be more than $1, and we would be not lumped in with all this junk that about 800 companies on the stock exchange are treated as. I don't know, Mark, you're on AusBiz, do you have the same sort of
I think it's a really good idea.
Okay.
I should have thought of it.
I'll just add one other thing if I can too. I think from a management point of view as well, a lot of my engagement with those shareholders who do choose to reach out to me, and you're always welcome to, you've all got my details, comes when there's a big percentage movement in our share price, a fear reaction. And unfortunately, with our share price being sub $1 by a lot at the moment, a 0.5 cent or a 1 cent movement seems to trigger that on a far more frequent basis than it probably should. So my hope a little bit maybe is that the market in general will adjust our PE over time, and hopefully people will like us and buy more of it. But also, if our shares were worth more per share, then one trade of $10 worth that moves our share price by 5% won't flood my inbox with questions about what's going on, which at the moment happens quite regularly.
Yes, I'd just like to, I'd just like to extend beyond what Andrew's just said. So suppose the share price changes by 1 cent. currently the value of our shares, when we look collectively what we own, moves around a lot. But if we have 1/5 of the shares that we currently own, we're going to get 1/5 of the movement in the whole value by 1 cent movement. Now, well, I know the 1 cent movement is not a 1% movement, it's not related to percentage, but that's not the way people think in the market. People think in terms of an absolute amount of money moving quite often. They just don't always think of a percent. So this would have the effect of stabilising and reducing the volatility that we're experiencing in the value of our shares. And that should stabilise the market a bit and make it look less volatile, and therefore people will be more inclined to invest in stock.
Thanks, Bruce. I'm just going to make one sort of facetious observation. If we get the same profits through a full year as you got in that first quarter, we won't have to go 1 for 5 because our share will gamble down that price and will be super.
I think they didn't gain assurance that we could do that, didn't they?
Thanks, Mike.
All right, so that, are there any other questions people have about the consolidation of shares? The resolutions up on the screen for the consolidation. So essentially, whatever shareholder you have, you divide by 5, and that's the number of shares you have. I don't know, and do you have any procedural comment as to when that comes into effect? And
yeah, it'll occur over the next 2 weeks, and everyone will be delivered a new holding statement by the commission. There's a timetable in the notice of meeting if you're interested. So yeah, there's a timetable in the notice of meeting which sets out the timetable for consolidation. It'll occur over the next fortnight. I don't know if we can share some observations on this, but you'll be sent a new
Will the share price be automatically 5 times?
Oh, well, in theory, yes, but not unless someone trades at that price. So in theory, yeah, until as everyone realises it, yes, and it should go, and it should be a 5 for 1. But you know, someone stupidly puts in a trade straight afterwards, still at the old share price. If it's the only trade, it'll move the share price back. One hopes people don't make that mistake.
I don't know whether you can answer the question, but will data providers like ComSec retrospectively adjust back in the data sets that you download? For example, in ComSec, you can download share prices at last 30th of June. Will that be retrospectively adjusted for more? Otherwise, the data set will show a huge movement in price on the day that the consolidation took effect.
It depends on the data.
Yeah, they adjust it. Yeah, it might take 24 hours.
Something. Or even sometimes 2 or 3 days. But Morningstar FactSet, who supply most of the data to most of these people, like ComSec and others, I don't know who they use, but to most people, make the adjustment whenever there's a share split or a share consolidation. It sometimes takes a couple of days. If it's a giant company, it happens quicker than if it's a smaller company. But yes, they normally would do that. So I would think you would see that in ComSec. I certainly would see it. I've seen in the past with my platform that I use.
So in CI, for example, you'll see it instantly adjusted.
So
it takes a couple of days, but yes, you'll see it corrected through the tenure or however many years they are.
thank you. So we'll all learn when we get our statements. All right. So the consolidation of shares, no more questions. So we'll move into item 6, the re-adoption. I think that's the key thing, is that we have an employee incentive plan at present, but it needs to be adopted every 3 years. So this is the re-adoption of the existing employee incentive plan. I don't think there was any revisions to it.
That data looks what was disclosed in the prospectus.
Okay. All right. So the resolution is up on the screen. The number of valid proxies votes we've received of this is also being displayed. Are there any questions? No. Okay. Item 7 is the approval of Andrew, CEO, Andrew Coleman's participation in the employee incentive plan. Because Andrew's a director, this requires approval at the annual general meeting for Andrew to participate in that scheme. Other people participate in the scheme, but if they're not a director, then that requirement is a separate resolution. So the full wording of the resolution is on the screen. The number of valid proxies votes we've received are also displayed on the screen. Are there any questions for approving the item of Andrew Coleman's participation in the employee incentive plan? No?
Andrew, would you say that it's going to incentivise you to work really hard for the next 4 months?
I think,
Or are we wasting our money?
I think, actually, it's, well, actually, if I do appreciate that, I like your sense of humour. I'm a large shareholder in my own right. I choose to take a portion usually of my pay every year in shares because I believe it's a good trade at the moment. As I mentioned before, around the median PE ratio. This allows me to do that directly from the company. On the other hand, I would probably do it anyway if the company didn't have this. It's just you would be giving me cash out of the company's coffers and then I would be buying it on market and there'd be delays and inefficiencies, instead of which at the moment the company is either issuing or buying on market and just handing them to me. So it's more efficient this way, but I'd probably do it anyway regardless.
The pesky Teaminvest people who come across these difficult questions. I said it's these pesky Teaminvest people who ask these difficult questions.
We should have, yeah.
That's right. Better to ask than wonder. So are there any more questions concerning item 7? No? Okay, we'll move on to item 8. Now, item 8, 9, 10 and 11 are essentially very similar resolutions concerning each of the 4 non-executive directors' participation in the non-executive director equity plan. So in the annual report, it explains that for our remuneration that's displayed, less the superannuation guarantee that comes out, half of that is paid in cash and half is paid in tip shares and has been, I think, all the time. And that will continue. And this is essentially approval to have a non-executive participation in a non-executive director equity plan that facilitates the issue of those shares.
Might I add one point? So the benefit of doing it this way, in years previous, we've obtained a resolution for each director at every AGM to approve the issue of shares. We're now setting up a NED plan. This approval will carry for 3 years and will mean the company can issue shares to these 4 directors to satisfy 50% of the remuneration of shares. But we won't need to bring this resolution back to the AGM for another 2 years. So this year just passed and the next 2 financial years, and then in 3 years' time, we'll reintroduce the same resolution. So it's identical essentially to how we've done it in the past, except this one resolution will cover us for 3 years.
Is it, Andrew earlier said that you're buying shares in the market, that is the issue. Is the intention to buy them going forward, or is that an option you're going to consider from time to time?
It's an option. So in the past, I think that there's been a combination of buying on market or issuing. I believe it's the board's intention to issue.
Yeah, well, I think it all depends on the share price. And so this gives us the flexibility to decide. So one of the other things at some stage, particularly with the share price being low, if you had extra cash, you know, you can consider other mechanisms by which you can buy shares on market. And this is one avenue to fulfill shares that we may need to issue in respect of remuneration.
Just to your question of are we doing it, we have almost every year we have tried to buy as many as we could on market to satisfy, subject to the caps that the ASX places on the price you can pay because there's rules. So the problem with us, of course, is often we have a bid-ask spread that means the company actually isn't allowed to purchase because you can't buy it more than 5% above the 5-day VWAP. So if you have a low share price, 0.5% can mean half a share can mean 0.5 cent on a share difference can mean we're just not able to buy it and therefore we end up issuing it. So since listing, we have bought the vast majority, but it's not always been 100% because sometimes you shouldn't trade. And again, I think that points to what we think of our share price.
I've been looking at these share incentive plans now for some time. I've always been concerned about the issue of new shares. Because in the first instance, it dilutes the holding of everybody else. None of the most successful companies that I've invested in, quite a few of them have purchased shares on market which they hold as treasury shares, which is what typically do. They issue the incentive shares from the treasury holding. That is good for the shareholders, it doesn't dilute the shareholding. However, over time, it can reduce the number of free shares out there in the market. And there has to be a balance around somewhere, but I think in general, the purchase of treasury shares when the price is down for this purpose is a good one. I won't name any other companies, but several I could that I'm interested in who do this. It's very successful, but there is a downside over time.
Thank you. Did you want to comment? No, sorry, it was an observation.
Yeah, conservation.
Yeah. No, it's one of those things that if you look now, it's at the end of October and we already accrued the amount in the 30th of June accounts and we can't fulfill it. And then you have a funny situation that if you don't get approval here, then you've got to pay it in cash. And then, so it's more to simplify the operation of it rather than to change the intent. Thank you. So what I'll just go through each item. So we have item 8 is approving Malcolm Jones.
Thank you very much. Item 8 is the approval of Malcolm Jones' participation in the equity plan. Are there any questions? Thanks very much.
Item 9 is the approval of Howard Coleman's participation in the Director's Equity Plan. The full resolution and number of valid proxy votes that has been received is on the screen. Are there any questions? No, thank you. Item 10, approval of Ian Cadish's participation in the Non-Executive Director Equity Plan. Once again, the full wording of the resolution and the valid number of proxies received is being displayed on the screen. Are there any questions? No, thank you. Now we move on to last item, the approval of Regan Paslow's participation in the Non-Executive Director Equity Plan. Full wording of the resolution, once again, is on the screen and the valid number of proxies received. Are there any questions? No? Thank you. Now what we do is we conduct a poll. So, and collect the ballots for each one. So do you want to take this down?
Simply grabbing the box. Oh, it is. Just fill out the form. Excellent. If anyone has any questions, they can
Yeah. So we'll stop the team's meeting for that.
Yeah.
Because the results, when will they be?
So Chair will tabulate the results after the meeting is closed and we'll announce them to market later this afternoon.
Okay, so the results of the poll will be announced to the market this afternoon. Thank you. So we